Directors, are you planning on selling your business? This is what you need to know about tax. If you're planning to sell your business, the sale price is only one part of the outcome. The structure of the sale can materially affect what happens next. Many directors focus on the headline valuation. What's the business worth? Who's the buyer? And how quickly can the deal complete? All of that matters, but what is often underestimated is the tax position, the availability of reliefs, and the planning that may need to be in place before the sale happens. Because once the deal completes, some flexibility may already have disappeared. A business sale is rarely just a single transaction. It may involve share structure, qualifying conditions, timing, extraction decisions, and what happens to the proceeds afterwards. So the better question is not only what will I sell it for, it is what will the sale actually mean for my personal financial position. There's one area directors often ask about is business asset disposal relief. This was previously known as entrepreneur's relief. Where it applies, it may reduce the capital gains tax rate on qualifying gains, but it's not automatic. The applicable rate depends on the date of the disposal and the rules in force at the time. Now, for qualifying disposals from the 6th of April 2026, the business asset disposal relief rate is 18%. But to qualify, conditions must be met. These can include shareholding, voting rights, being an officer or employee, trading status, and ownership period requirements. So the important point is this: these conditions are not something to think about only at completion. They need to be understood well before the business goes to market. And this is where many directors get caught. The timing and structure of profit extraction before a sale may also need careful consideration. Dividends, salary, pension contributions, retained profits, director loan accounts, and pre-sale planning can all interact with the wider tax position. And this is not something to guess. It's not something to leave until the final weeks of a transaction. Directors who check early generally have more options. Directors who leave it late may have fewer. Now, this doesn't mean that every sale needs to be complicated, but it does mean that the tax and planning position should be understood before decisions become difficult to change. There's another layer to this, because many directors assume the sale of the business is the end of the financial story. It isn't. The sale is often the beginning of a new financial chapter, because once liquidity arrives, the question becomes, where does that capital sit? How is it invested? How is income drawn? How does it interact with pensions, inheritance planning, family objectives, and long-term retirement needs? So a successful sale can create opportunity, but without coordinated planning, it can also create unintended friction. So the directors who plan well are not only focused on the valuation, thinking about the structure before, during, and after the transaction. So if a sale is somewhere on your horizon, even if it's a few years away, the question is not only what the business might be worth, it's whether the structure around the sale is being reviewed early enough. If you found this useful, you may wish to subscribe to the channel for regular updates on director focus planning. I'm Stephen Pitcher, and I'll see you in the next video.